year to try to help his accountants get stuff fixed. He trusts them. I said, okay, if as long as it's above 795,000 to whatever, we'll pay the 3x, whatever that is. And he agreed to that. So they're doing their due diligence now. We should have that done in the next couple of weeks so they can confirm the SDE. He doesn't want to let us do any more due diligence until that SDE is confirmed. In fact, and we agreed to a 60-day due diligence period and close soon as we can after that 60-day period. But he doesn't want us, and we have a extensive, especially GovCon, but just regular business due diligence is pretty extensive, confirming everything, right? He wants to not let us. He says, "Well, I'll give you guys access to this 10 days before we close," which it isn't going to work. So and I got a feeling because he's very frugal that he's not going to want to pay an attorney on his side, which is a problem. I told him, I said, you need to have an attorney because I don't want you coming back later saying you didn't know what was going on. So
Right.
I don't know, some advice on how to deal with this guy. I considered, because he wants to draw up all the definite agreements and purchase agreement stuff before he allows us to really do due diligence. So I considered just drawing it up myself so we could get into due diligence. And if all goes well and we go to close, I just give all the stuff I give over to Grant or somebody to fix, right? But it gets us into that conversation. But I just want some advice on how to deal with this fella. And I don't want to waste a bunch of time. Definitely don't want to waste a bunch of money. It's a good company. It's $8 million in top line revenue, mostly GovCon work, some state work, and it's 800 to $1 million SDE is what we're figuring.
Well, I mean, so it sounds like the most you have at risk up front is 19%, right, for the down payment?
Well, it's 19% rollover, and the remainder of that's 2 million. So
Oh,
it's
so I know
about
you said there was, so is there no cash up front? I heard 33 year one, 33 year
about
two,
685 up front.
685,000
Yep.
up front.
Yep.
Yeah, no, I mean, without being able to do due diligence, you're not going to close until you have the due diligence done. So I think what you do is you basically have your LOI that you have signed. You've got your agreements that you're talking about. I mean, I would way rather bet 5 grand or so with Grant than I would 685 with seller who won't let me look at what I need to look at, and get in there. My guess is that there's not anything squirrely, although that is definitely a risk. My guess is the guy's just very, very beyond frugal, just
And
cheap.
he's paranoid. He thinks we're going
Yeah.
to get magic sauce and use it against him or something.
So cheap and paranoid is not good. But I mean, but you've got to see what you need to see before you stroke a check for 685 grand. So I think you can get the docs done and then have the 10-day timeline. You can do due diligence in 10 days. I think what you're going to need to do, just get it all lined up so that you can do that, and then build in an extension for that in the event that he has not provided you what you need. And then you basically say, look, I'm good with the 10 days, but if you don't get me the stuff, then like if I don't have that stuff to work with, then it's going to be longer based on however long it takes you to get me what I've asked for. And I might have to ask for some stuff that you didn't give me. So as long as you build that in, then I feel like you've kind of got, some wiggle room, and you can get what you need before you stroke that check. But I just say, so I can't write you a $685,000 check. Nobody's going to do that under any deal without having all the information. And my people need time to to see the stuff. I would also write 10 business days, not 10 calendar days,
Right.
in there. I think if you do that stuff, then your risk is going to be some thousands of dollars with the attorney, but I think that's a heck of an investment to get the deal that you feel like has a good chance of going through, and protect yourself. Does that helpful at all?
Yeah, I think so. Is it generally true the longer we're in this process and the less likely it is that he'll walk away?
Yeah, the more invested anybody gets in a deal, the less likely they are to walk away, because they view it as losing the time they spent doing this. So I think that's good. You don't need to have him have an attorney since you're not an attorney. So, it's like, it's nice. That's a nice to have. And you tell him you've had the opportunity to get counsel. You can put in the contract, you've had the opportunity and we've recommended that you get counsel, but you've declined, that kind of stuff can go in there. But ultimately, adults are adults and they can sign, the thing without having an attorney look at it. And it's not necessarily going to come back and be a bad thing for you as long as they had a
Okay,
chance to.
good. Yeah, I
So,
was a little concerned about that.
yeah. So I think those are my things is build the business days versus calendar days, build the escape hatch of he has to give you anything that you've asked for in writing within 24 hours, and if not, then you get extension. Get Grant to do at least a cursory review, put together everything you feel like you need to, and then give it to Grant and just tell him what the concerns are. Grant's the attorney for anybody that's listening and doesn't know that, and then I think if you can do those things, then you've got enough wiggle and cover to get you where you need.
All right, cool.
All right.
Well, thank you very much. Appreciate it.
Aren't sellers fun?
Yeah, I've learned a lot about sellers in the last year and a half.
Deanna, you
Yeah,
would say
yes.
they're a special snowflake and bless their heart, right?
Yep,
Bless
bless their
their
heart.
heart.
That's right.
Yeah. And hey, Sam, I just sent you another email intro as well. Maybe that'll help you. So you should have like 5 or 6 now from me.
Oh, you're
So
awesome. Thank you.
I'm happy to help, buddy. All right, Menon, you are up. How are you today, Menon?
Amen. In.
I'm doing good. I'm doing good. Diana, I just heard your podcast with Roland where you talk about your trucking business and all that. It was and the mindset and all that stuff. Very, very
Oh,
nice.
thank you, dear. I appreciate that. Roland does a very good interview. I just follow his lead.
No, I think both of you are great. Uh, Hey, Roland, you missed my message. I had sent a message last week when we talked about some thing, and I think we can maybe have it separately.
Okay.
Uh,
Was that a direct message?
it was a direct message. I think you had
Okay,
said
I'll
that.
go back
Send
and
me a
look for
message.
it. We had my mother-in-law was in town for 3 weeks, and she
Oh,
ended up getting some terrible thing that she had to go to the hospital for. She's still there, so we had a lot of flurry here at home. So I may have missed something. So I'll check it
sure,
out and reply to you later today.
sure. Thank you. Sorry about your mother-in-law. Hopefully she's okay now.
She's getting there,
Uh,
hopefully.
yeah. Okay, cool. So I have a question. I was looking at
You have
your
another question other than the question you sent me? This is mind-boggling. I can Okay, this just this one time you've got an extra question. That's good. I like
that
it.
that wasn't a question. Okay. Uh, okay, so you talk about fractionalizing a company, right? And you talk about tax advantages of doing so. Is that mostly like spreading gains across years, or maybe different treatments for different fractions? Is that what you mean? And
Well,
is
not
this
not gain so much. I mean, it can be for that, but it's really just to give you the flexibility to have um, a throttle to or a system of switches to move income from one place to another based on what makes the most sense. Sometimes the company needs income for capital. Sometimes it's accumulating income, and it might be more tax advantage to move that to a different entity that's located in a different tax structure. So I think it's really the first level I like is protection, just general liability protection. So if I've got these walls that I've built up in the forms of different entities based on liability pockets, if I think there's going to be liability here or we're starting a new business there, then I want to protect all my existing businesses from that. And even within a business, I want to do that, right? So we're, distributing in the United States and we want to distribute, in Europe. I don't really want to expose my US stuff to GDPR claims and things like that. Then the second thing is cap table. So I don't necessarily want to give new investors who are going to fund a new kind of expansion or initiative ownership in all the other stuff that I've done. So definitely not the holding company, maybe not the operating company, probably just the new thing that we're going to do. Like we've got company-owned stores and we're going to try franchising. I'm going to raise money for the franchising, and I'm not going to really give them ownership in the company stores because why do that if I don't have to? And then the next thing would be income. so that I can say, who needs cash flow and how do I have the ability to steer that cash flow to where it's needed the most in the most tax advantaged income tax way. And then the last one that I can think of off the top of my head would be gains, which would be if we're going to sell, a capital asset or do some sort of conversion that's going to create a tax event or do an exit, then I'm going to think, what's the best way to position that as well. So I'm really kind of processing those four things pretty much in that order as I'm thinking about that.
Got it. And this is the same thing that you call goose and egg strategy, right?
It is.
They're same. Okay.
Goose and eggs,
Got it.
absolutely.
Okay. Cool. The other question I have is, I was talking to somebody who just did an acquisition, and he was in Epic before, and he ran into some fraud. And I have experienced it too during my real estate syndication days when we purchased an apartment and then we found out later we had due diligence and all that. Despite that, there were some fraudulent transactions. And in this case, I think they relied on seller bank statements and they reconciled everything and everything was fine. And once they were in, it was all cooked. So how much of due diligence fraud can we actually detect before buying? Because sometimes if you this can literally like wipe you out, right? Like one big deal can wipe you out. So
yeah, I mean, you don't have to look too far into very sophisticated financial markets to see that if somebody wants to conduct a willful, intentional, deceptive fraud, they can do that. You can look at Bernie Madoff and was it AIG? All those big companies. Enron was the one I was trying to think of. So there's all kinds of sophisticated due diligence finance people looking at all those statements and regulators, and still yet it happens. So I think you think basically if somebody wants to lie, cheat, and steal, they're probably going to be able to do that to some extent. So we're really doing what we call confirmatory due diligence more than exploratory due diligence. Confirmatory meaning they told us that they had this much in sales, then we can go to actual third parties like banks and get bank statements that are prepared by those third parties and compare those numbers to the numbers that the seller gives us and find out, can we confirm that in fact the amounts that they said happened in terms of deposits and things like that. But because of accounting differences between like accrual and cash basis and revenue recognition and all that kind of stuff, you may or may not be getting the full story that tells you what you want. But you can get pretty good with general cash. You definitely don't want to rely on representations of things that can't be confirmed, like, hey, Menon, listen, man, I know we said we did $1 million in sales, but we did 500,000 more in cash under the table. And so you'll be getting that, okay, well, now that doesn't make me feel good. That scares me because now I feel like there's tax liabilities that might come over into, post-sale or something. So, the exploratory due diligence is more like where you're really taking time to go in, and it's usually too expensive and time consuming to do that. And even then, if somebody wants to lie, cheat, and steal and they're manufacturing things and doctoring documents and stuff like that, it's very difficult to find that out. So our big hedges are in the agreement. One of the more popular things that's coming along right now is something called RWI, which is representations and warranties insurance, so that the reps and warranties that we're making the seller make in the sales documents, in the asset purchase agreement or the entity purchase agreement, are basically insured. So number one, we want them to make all those reps and warranties. Good attorney can do that. We have lots of forms and templates in the portal on it. The second thing is that in the event that those are inaccurate, then there is insurance that we can buy, and we basically charge that to the seller so that the seller is able to get their price. We're like, hey, it's going to cost me 50 grand to get reps and warranties insurance to cover these things. So I'm going to basically charge that to you. Instead of $1 million, it's going to be 950, or at least 50 of the million is going to go for that because you're paying for that. Then the second thing, which is, that's basically you get your money back if they lied, right? The second thing is the right of offset. So you want seller financing, like in the deal that Sam was talking about, right? You've got, 33%, you got a 19% roll in, you've got 33% after the first year, 33% after the second year, and the balance after that. Well, I've got all those things, if my document is drafted properly, to offset and claw back, and I don't have to go to court. I don't have to do anything. It's just a straight out right of offset. And then the other thing that is for years and years has been in agreements is a thing called a basket or a holdback. And the basket or holdback is basically an amount that can be pretty significant. You know, it can be 10, percent or more in risky deals of cash, like of that 685 that Sam was saying they're going to give them. That absolutely, there should be a holdback on that, right? There should be at least 62,500 holdback on 625 and maybe more based on that deal. I'd probably try to get 30. So then you've got that as well. And that's usually done for 3 years or so. And over that time, when you find things that are, that are misrepresented or that were inaccurate, let's give them the benefit of the doubt, then you have the ability to take that money straight out of escrow. Or the way that we like to do it when we're doing settler, our creative financing is we basically self-fund the basket from a holdback ourselves, right? So we just say, I'm not going to give you 625. I'm going to give you 625 minus 130, or let's say 500 minus 125. I'm going to give you 500 now. 125 I'm going to hold back. And then I'm going to release that after 3 years if everything that you said was right. So those are a lot of the things that we've got to work with to help us with that. Does that make sense?
Yeah, no. So you're saying that it's really hard to actually eliminate fraud. So you basically build protections using warranties and other.
If people want to lie, cheat, and steal, they've been doing it for thousands of years. They're probably going to be able to, get away with, with something in terms of putting something past you that's not accurate. When that's discovered, you want to have as many remedies to get yourself whole as possible.
Got it. And is it normal for people to get view only access to the bank accounts? Is that something that is okay to ask for instead of relying on bank statements?
Oh, to look at online statements, that would definitely be something that I would want I would want my accounting people to have access to their accounting systems. That's pretty standard stuff, as opposed to give me paper that could be falsified. Yes.
Right, accounting systems, but in the bank accounts, right, operating accounts and all their bank accounts, view only access. Is that normal, or is that too much?
I'm never in the weeds enough on that to know if they're doing that or not. I don't think they are, but you'd really need to talk to a due diligence person to get a good answer at that level.
Okay, cool. Thank you.
Yeah,
Roland.
Pleasure. Good questions.
All right, Scott, you're up next, my dear.
Hey, Scott.
Hey, Roland, how are you?
I am fantastic. I know that in addition to Menon, I didn't respond to your podcast question, and next week will generally be good as long as it's in the late afternoon.
Perfect. Let's get it set up.
Yep.
I've gone through the Consulting for Equity sprint 3 or 4 times. And I'm a better consultant for it. So thank you very much for that.
Great.
2 questions. One of the things that you mentioned is when you're going over agreements or contracts, you call and talk to the other party every time?
Yes.
Okay. That's question number 1.
Yeah.
Question number.
Let's give some context there though, so that it helps everybody. So let's create a scenario and talk about it for a minute. So what's happening that causes you to ask that?
Yeah, you had mentioned in the recordings that when you're sending out a letter of intent or an LOI, that you get the other side on the phone or on a Zoom or in person, and you walk them through each step of the process.
And why do I say that?
So that you can get live real-time reactions and answer questions and concerns as they're happening.
Exactly. Yeah. I just think it's a mistake to, and it happens like we're going through an operating agreement on a company we acquired a couple of years ago. And we ultimately all decided that we wanted to kind of do this different tax treatment for it. So we're doing it as a reorganization, and it's a Type F reorganization, so it's just in name only, but it just made everything cleaner. But it has been very difficult because the seller in that deal was really paranoid about being taken advantage of, and they have a kind of an emotional reaction to anything that's different, right? So we met all physically to go over everything that was going to be in the final agreement. We had some significant negotiating points. We were able to reach agreement on everything, and then we prepare the agreement. And this is something that we've been through for over a year, right? So like it's like we've been talking about it a lot, and we sent the agreement over and said, here it is. And if there's anything that, we tried to capture everything. There's always things for clarifying and stuff that need to be done. So take a look and then talk with us. And still the message that came back was, and it was a redlined agreement. Redline, for anybody that doesn't know, is it shows all the changes, right? And it's still the message came back. Looks like you guys are trying to, I don't know if it was pull one over on us or put one past, something like that, right? Just and it's just an unfortunate phrasing that the seller uses because he's a really good guy, and the deal is has been already a win for everybody. But even there, with an ongoing relationship that we've had in that relationship, it's been a couple of years. It's been good for everybody. We had multiple meetings in person. We agreed on all the points. We send it over, and still there's that, right? So that to me is a really great extreme example of even there. I guess we maybe should have gotten on, a Zoom or something and done it. It felt like overkill because, of the clarifications. But so think about somebody that you don't know at all, that you're in this deal with, and you're buying, their baby that they've birthed and created or bought from somebody else, and now they're thinking about selling, and they're paranoid and skittish and afraid of fraud, just like Menon is and everything else. And then you come in and you basically send this kind of dictatorial, this is my offer. And there's no real context around it in terms of, hopefully, because I say don't ever send an LOI until you've had conversations either, by the way, right? But even when you do, you want to talk through it so that you can immediately dispel any mistrust or misunderstanding or misconstructions of what's going on, or explain something that might have some emotional trigger for them that you never had an idea would, because you just don't know. The other wonderful thing is that from a rapport building standpoint, you generally don't get to spend that much time with the seller before you do a deal. So an opportunity to spend time with them collaboratively is a positive thing for you as well. So, and then it also gives you the ability to see, like, if something was kind of triggering to them that doesn't matter, you're like, oh yeah, no problem. We can change that. Now, reciprocity for negotiation says that that's a give from you that should give a get from them, even if the get from them is just a little bit more trust or a little bit less pushback on something else. So I really feel like it's important to do that because, for all of those reasons.
Perfect. Second question. When you're doing a consulting for equity deal or an advisory role, and you have somebody in one of the departments that's giving you significant pushback, but it's also causing the deal to not get done properly, how do you address that?
So give me an example.
So, got an advisory role, somebody in accounting doesn't want to fulfill on what needs to be done because they just don't feel comfortable with it. So it's holding back activity, it's stopping progress, it's stopping revenue,
Okay.
which in turn stops, some of the CFE deal, the consulting for equity deal.
And the question is, how do you handle that?
How do you address it?
Well, I have gone through that several times,
That's
and
why I'm asking.
I have. The answer is that it is a negotiation with the person who is the constraint, who's the bottleneck. So I think it's important for you to be able to communicate with them directly and collaboratively and build rapport with them to understand what it is that causes them to have the feeling that whatever you're talking about shouldn't happen. Accounting is a great example because I will frequently have spirited debates with CFOs and controllers about rev rec, right? Revenue recognition. So like we're switching to GAAP from non-GAAP, and we are currently recognizing 100% of revenue on a contract, let's say, for a tax return, for example. Tim, if you're listening, love you. And you're saying, well, you, the accountant, is saying, well, you can't recognize the payment that you just got until next year when the tax return is done because you got a payment in February for a tax return that's not going to be filed until next April, more than a year from now, right? So I guess we don't count any of that as income. And you're like, oh, wait, man, I have to explain that to now when I exit, why did we have this giant precipitous fall off in income, during this year? Oh, it's because of rev rec, but still that's hard. And from a cash flow standpoint, I got to be careful because can I spend that money that's really a liability right now because it's a work not yet performed? So like my solution there was basically, okay, well, let's take a look at it and say, as with, to me, pretty much everything, let's start with, can we cut this up into little pieces and find of the little pieces what I can get paid for today and recognize today? And so that's where I start and then say, okay, well, we do have a consultation on the front of that. So we could basically structure our contract in a way that allows us to recognize the consult allocation right now, even though the clerical preparation of the final return and filing isn't going to take place for some time. Now, notice how I worded that. I said, well, what's the value on, let's say, a $3,500 tax prep contract? What's the value that I can attribute to the clerical mere filling out of a form effort? Well, what does an hour of the accountant's time on our side cost to do that? Cost to do that. Let's say that we charge $125 an hour. Okay, how many hours is it going to take to do that? Let's say it's going to take 4 hours, right? So 4 hours is $500. So now I've got $3,000 of money that was going to have to be waited. That you were going to have to wait a year to recognize that maybe I can recognize today, as long as I can come up with $3,000 worth of services. Okay, great. I've got a consultation, which is a meeting. Maybe I've got a couple of those. I've got access to our tax portal. I've got a planning meeting, and I've got strategy. So now I've thin sliced it into 6 or 7 things. If I can then take all of those things, accountant person, and those are things that we're doing over the first 60 days, can I recognize that now? Well, yeah, I guess we can. Okay, so I've got to redo the contract, because under the contract that we had, it was basically we're charging $3,500 to do a tax return that's going to be filed a year from now. That's bad. I can't argue against that. But as long as I open my mind and say, how do I thin slice that? And then could we possibly reconstruct that contract so that all our contracts going forward say this, and then we get to recognize 80% of the revenue now when we do have to defer 20. And this is a really long explanation because I want you to see the process, right? And I can't go in there like I used to when I was younger and say, dude, you're stupid. No, we're recognizing it now. I can't do that because A, that's wrong. That's being a bad human. But B, I'm not going to get anywhere with them. And I've built an enemy that's going to put up roadblocks every single time, So instead of the you're dead to me philosophy I used to have, and I'm just going to push my way around you and bully my way into having what I want, it's got to be you form a relationship with each of the people that are potential constraints or that come up as constraints. You hear them out, you talk with them, you bring them in, and ideally, instead of saying it the way that I just said it to you, it's a much longer process of, gosh, well, I wonder, could we, if we were doing some of the work now and some of the work later and it was split into different things, is that something that you would account for differently? And then they tell you, oh, well, then the way that works is blah, blah, blah. And you're like, God, that's a great idea. Let me give them some credit for what they're coming up with and lead them through an interview question asking process to the inevitable conclusions that you want them to come to so that they're their idea and they're bought in. That's going to get you miles further with each of those people who are difficult. I will say, and I currently have one of these too, there are people who are just, they don't like your deal that you made, and they're going to fight against you and throw up roadblocks every step of the way because they're like, I want the Scott deal. How come Scott's got part of the company and I have to work 7 times harder than Scott? And it's like, do you know all the things that Scott knows to bring value to the company? And is the value that you're bringing your labor, or is it your brain, right? If it's your brain, and I know, that's the old story about the plumber that charges $100,000 to fix the big ship, by just banging on one thing. He's like, the bang is 10 cents. It's the whole rest of the fee is knowing from all of my experience and time that I've put into this, what to do, where to bang, how to do it, all that. So so I think that is really the way that you want to go about it, is when that constraint happens because of that person that's throwing up the objection, really do hear them out and understand it. And rather than just be going, that's dumb, even in your head, try to say, like, I still have to catch myself because I'm like, we could totally get around that, but I can't say that. I just have to go through that process. They need the process, the respect, the understanding, and the hand-holding, and the rapport building and the relationship before you can get them to get on your side. But when you do that, then they can end up becoming your strongest advocate, and then everything becomes collaborative and it moves much faster. So it is definitely better to do it that way than the way I used to do it. Does that help?
Thank you for that. Very helpful. Thank you.
Cool. Did you have one more?
Awesome.
Nope,
Scott,
okay.
are you good?
Nope.
Okay.
That was
All
it.
right.
Thank you so much.
Yep.
All right, Deepak, you are up, buddy.
By the way,
Hi.
Scott, hey, Deepak, by the
Hi,
way,
Roland.
Scott, how you doing? Scott, if you, when you have that conversation or try that strategy, I'd love for you to come back here and let's talk about it and share with people. And then we can kind of debrief on, how it went. Would there be any other options of doing things differently, et cetera? Because I think
Perfect.
that's an interesting thing for people to hear.
Will do.
All right, Deepak, what's going on, man?
Good. Yeah, Sam was talking about the deal. We are working on it together
Yeah.
with the same guy. He has his secret sauce of this GovCon company is an India company with their 34 contractors who do all the bidding for all the contracts and stuff.
Yep.
So one of the things that we are concerned about that once we take over, how to make sure through agreements that we don't lose them or one is the legal conversion of the company to our name, which is a CPA and attorney can do that.
Mhm.
But in addition to that, these 34 employees, they're not employees, they're contractors. They're all remote within India. He says, yeah, I will sign over them, but how do we protect ourselves? Because
You have,
this,
your attorney will get you standard protections on contracts with respect to non-poach, non-compete, that sort of stuff. The challenge is you've got multi-jurisdictional stuff and international deals. So, how enforceable is that in India? If is he in India as well, or the US?
No. The seller is here.
Okay.
There is a guy who just does he's a legal, he doesn't do any work. He owns the company. He's a one person. But all these contractors report, he does the payroll and, he's like an admin CEO.
Yeah, so it's basically just that's going to be contractually covered, and then what you have, because of how that deal is structured, is the roll in of the 19%, the 33 balance of the amount that's being financed, all should be subject to offset, and you should build in a clawback in the event that any of those people leave. Particularly, what you might think about doing is, if there's 34 of them, is figure out what is the pro rata contribution that each of them currently has or had over the last 12 or 24 months to sales, and then some portion of the purchase price should be cancelable in the event that one of those people leaves. And so, like, if 3 of them left within 12 months, let's say, then, and they accounted for 16% of total sales, then I would discount the purchase price of the company by 16% and have a clawback or cancellation right against either the roll-in or I probably wouldn't want it against the roll-in. I'd want it against the cash that I was supposed to pay, that first year.
So he also said that he doesn't want to do roll-in, and it was because of one reason. He brought an opportunity to Sam and his team, and they didn't act on it immediately. And he called me. He says, "Man, what kind of a company you guys will run if you don't take every opportunity?" And that was his reason of not rolling over, because
that's just negotiation. That's up to you. You can say, sorry. That's at some point you have to just say, hey, this is the deal.
This is the deal. Yeah. So that is the best way to protect any reps and warranties type of thing can help here, or?
Well, your reps and warranties would be a little different. Like, it'd be difficult to represent or warrant that independent contractors were going to continue to work for the company, because as independent contractors, they certainly have the ability to go and do whatever they want. And if they're true independent contractors, they can work for other companies as well. So that would be, that would be not really a rep warranty thing. It would be more of something you'd build into an earnout or contingent value, right?
No, I mean, these guys are, sorry, my mistake. They're full-time employees of this company in India, but they're remote. They're not like contractors, like in
Oh,
true.
okay.
Yeah.
Yeah, the same thing applies though. You're not allowed, at least that I'm aware of, anywhere in the world to have slave labor. So they can quit. But when they do quit, if they do, then that creates an issue for the seller and for the company. So I think you build that in, and like I said, either in CVR, clawbacks, or earnouts, those would be the places I would build that protection in.
I put in there as one of the conditions of closing that before we close, we need a 60-month exclusivity agreement with that company in India to keep doing what it's doing, as a basis while we work on transitioning.
Is the company in
acquiring
India a
company.
subsidiary of the company you're buying? Are these employees of, or is it a separate company that's
Separate. It's a separate company.
Okay.
So
And who owns that company?
There's somebody else, not this guy.
And have you talked to the owner of the company?
Not
company?
yet. Not
Okay.
yet.
Yeah.
Not
So
yet. Yeah.
That's one of the
that would
things
be
we want to
critical.
do that he doesn't want us to do yet until until the deal's done. And I think I did put in the LOI clawback language on the second to 33%, contingent on the India deal happening.
Yeah.
Yeah, I mean, it
No,
should be on the
yeah.
first one, right? Should be on the money that comes the soonest. That any offset that happens before that payment is due should be applicable to the next payment that comes due.
My main concern is like those employees might come along because they get paid well and all that. The question is that how do we duplicate their knowledge? Like, should we say the 6 months they should definitely be there, or retention bonus, or things of that nature? Like, is retention bonus is what I was thinking, to make sure at least they're retained for 6 months, or some kind of a bonus to retain.
I honestly don't know. You've got to talk to the owner of the company. That's a critical thing. I wouldn't give this guy a nickel until I talk to that. I'd just be like, how am I supposed to do that? Go
Because that is the reason this business is so profitable, because his payroll is only 15,000 a year for 34 employees.
Yeah,
So a month.
I do think it's really important to that's such a critical dependency that you guys have. You might want to either buy that other company as well, or at some point you're definitely going to want to SOP that process, because the value of his company without that company coming along is next to nothing.
Yes.
So I like with that knowledge now, I mean, I would be strongly disinclined to buy his company at all, because it's so dependent upon this other company, unless I could get that other company as part of the deal or have.
It is part of the deal. It is part of the deal. We are just trying to protect the SOP part. What you just said is the right word. That how do we put in agreement that, hey, we need 6 or whatever, however long it takes, to make sure if these guys leave, we can hire another 34 and not lose a beat or something like that.
Yeah. So that would be definitely stuff you would want to have in that agreement. So
Okay.
As usual, it's more complicated than the initial way that you described it to me.
And we won't have that information on how that company actually works until we do due diligence.
Yeah, and he agreed to doing that, but yeah. So, yeah.
Sounds like he's just a difficult paranoid seller. That's not atypical, and you just kind of have to coach him along, and you'll earn the deal once you acquire it, but just don't do anything for expediency's sake or because he's of his paranoia that puts you at risk for your capital.
Yeah, makes sense.
Okay.
Thank you. And one question for another deal. To ask people for bank account, for the access to bank account, is it through QuickBooks that you do, or is it through their bank statement?
So QuickBooks would typically be for financial statements, and the actual online banking would be for direct bank information.
So, okay. All right. Thank you.
You're welcome.
Good questions. Good questions, Deepak and Sam. All right. Jim Smith, how are you?
Hey, Jim.
How are you doing? Can you hear me?
We
Okay.
can.
Yes.
All right. All right. Thanks. Good to see you
Likewise.
here. Um, a couple questions. I've got this towing company that is for sale. It does about 11 to 12 million dollars with about 50% margins, unadjusted. And then I bring the tax planning alongside and significantly reduce that. So at this point, we've got some buyers that are beginning to line up. Um, the equipment has a value of approximately 20 to 25 million dollars in terms of appraised value, and then there's another maybe $5 million of real estate that's alongside. And my first question is really the positioning of it. I've seen Roland in our training materials the idea of combining kind of the equipment and the leasing in a combined in order to basically sell that as something that maybe that the buyers want to buy because they can write it off faster, especially the equipment
Uh-huh.
compared to, for example, selling the business itself, which has got a value of approximately um, $6.5 million net income unadjusted that could have a multiple that seems to be growing based on the marketplace. Um, so my first question is relative to that business. I've got a couple of other business questions on other businesses, but how to position this from a sales standpoint, um, and is there anyone in particular that you would go to in order to kind of enter into this process?
So those are pretty broad. So is the
Yeah.
question, how do we capture the multiple type value in a sale for assets, and where do we allocate, or what's the specific?
What's the best approach between kind of the equipment and real estate sale versus the multiple on the business or some combination of that?
So the multiple is where I'm going to get the value. And then it's so like if businesses like that sell for 6x, then and let's say it's a million, in profit, then if businesses like that sell for 6x, then I'm going to say 6 times a million, 6 million is the price of the business, whether you buy the assets or the entity, right? So now then it becomes, if you buy the entity, we don't have an allocation issue. If you buy the assets, we have an allocation issue. Real estate and things that are easily valued at market are kind of self-explanatory what they're going to be, and then the difference comes down to the haggle over what they're going to be trying to write off and to capitalize and write off versus goodwill or IP or other intangible things like that the difference between the physical asset values and the multiple price are going to be assigned to, and then assigning those in the way that is best to you, versus best to them, and then you haggle over that, right? You've done that a million times, I'm sure. So that's really, that's where that's going to land, and then it's just a question of, okay, great, I've got a 6 million purchase price, I've got real estate of $1 million, I've got assets of $1 million. What do we do with the other 4 million? It's goodwill. Well, that's going to be written off over this many years. Is there another way that we could assign that works for us as seller that also helps the buyer? And then you come up with something that, that everybody's at least, is acceptable to everybody, if not happy.
Um, so the secret to the profitability is that the equipment is paid for.
Yep.
And the big challenge for growing any capability in this marketplace
CapEx.
is the cost of the equipment and the ability to really make money while you're paying high lease fees or lease with a right to purchase.
Hmm.
fees. So when that number gets adjusted, much of the profitability disappears from the business itself.
Uh-huh.
If they're going to buy the equipment separately
Uh-huh.
from us, would you how would you pay attention to those different dynamics in the value of the business versus the write-offs relative to the equipment and obviously slower depreciation relative to the real estate?
Yeah, I mean, to me, any good, uh, if you get an unsophisticated buyer, then maybe they'll pay on an unadjusted multiple. But a buyer grade EBITDA is going to include replacement cost, some sort of sinking fund for additional,
You're going to have to,
equipment.
right?
Yeah, and so then it comes down to, are there creative ways to continue the advantage of having the equipment paid for, and maybe that is through acquisitions of other towing companies that would help. Like it's, to me, it's going to be, okay, so we've got $2 million of assets that give us a tremendous advantage because we're not paying finance purchase payments or lease payments on those. How do I continue that advantage beyond the useful life of the equipment? Well, what is the useful life of the equipment, and what is the maintenance on that? The maintenance is
Right.
probably already included. So then it's going to be like, at some point that stuff's going to break down, but that's pretty durable stuff. So could I replace, do I need to replace, let's say, 20% per year of the equipment? If I do, maybe I could find that through excess capacity that exists in acquirable companies that could be acquired at a lower multiple or a lower valuation, because they're experiencing that same thing that we've gotten past, but they are only operating at 50% capacity. And if we use a capacity acquisition strategy to basically continue our profitability, then maybe that's a way to do that, right? Those would be the things I would be thinking about.
Right.
Or is it less expensive to become a lead broker for other companies, and we're really moving into, we don't really want to own the equipment, we want to be Airbnb, where instead of owning the hotels and renting out the rooms ourselves, we're just facilitating the ownership, and we do that and become a lead network for towing companies. That'd be another thing to think about. Or could we go into a very highly profitable adjacent business like towing insurance, where we captive insure for ourselves, and then offer towing P&C specialty insurance for other companies that we provide these services for? I'd be thinking about things like that as ways to maybe overcome the constraint that you've got there.
Yeah, that seems like a tough sale. Yeah,
Seems like
yeah.
what?
I mean, it seems like a tough sale for the buyer. The buyer's got to buy into acquiring other equipment. I mean, this place is, you can eat off the floor. The equipment is beautifully maintained. It's worth more than it would normally be. It'll last longer. So there's a lot of value there. That
I mean, yeah, there is, but it is what it is, right?
right. And I'm thinking that the write-off obviously depends on, we're talking about Illinois and Missouri, so fairly high tax states, and the write-off, then the accelerated write-off being worth a certain amount of money that should inure to our benefit, depending on the structure of the deal. Any thoughts about that?
No, I mean, I think you're circling around the same thing, no matter what. The issue is, if the profitability is based around the fact that an expense has been prepaid, whenever the prepaid expense expires, the piper has to be paid again, and then that's going to be allocated, over the purchase price, and it's going to go into the pro formas, and it's going to impact EBITDA negatively, or it's going to, impact valuation negatively for sure. But the question, I guess, would then be, what's the useful life? Because if the useful life is beyond 5 years, then it's kind of like, well, that's just how it is in every business, right? We already paid this, so you're getting the benefit of that. You're going to get 5 years of above average earnings, and then you're going to have to figure out what you want to do. But that's really not for us to decide. That's for you, buyer.
Right.
So I think that's probably it. Would be our moat is our SOPs that allow us to have an extended useful life on equipment that has already been paid for. And that is an advantage that will continue for 5+ years. If you can sell that, then it's like, well, every business has to replace their equipment, so it doesn't really matter. So we're not going to accept a restated balance sheet, income statement based on that.
Right. Okay. Okay. And then are you using, relative to this particular business, are you using AI in a situation like this to create to create the presentation? Ultimately, when the solution is reached about what's the best way to present this thing, then how are you using AI, and do we have any prompts available in our system for essentially packaging the presentation?
Yeah, because they're so specific, we don't really. But what we generally do is we will build the presentation in ChatGPT slide, the slide by slide, and then we'll take that over to Gamma, or I forget what the new one is that we're using. But we'll take that over to Gamma or the other one that's got just initials that I can't think of. But Bailey or Deanna can remind me, or you guys, or Bailey or Deanna, you can get it from Matt Gray. But the like ChatGPT and Nano Banana, the Gemini, all of those, they do terrible job at creating presentations. So you can have them build the prompt for you to put into the AI presentation creator software, and you'll get an okay presentation, but then you're ultimately going to have somebody take it into Canva and tweak it up and make it, significantly better. We're still a ways away from that. And like, I can get from, I think Claude has given me the best slides, but like after it does about 8 of them, I don't have any 8-slide presentations, So like after you get through 8 of them, you're kind of done, and finding or having it give you more slides in the same format is impossible. So you would have like 8 slides that look great that are in this one thing, and then a completely different look, and it looks ridiculously unprofessional. So there's not a good one for that yet that I have found.
Right. Okay. Speaking of the AI, well, actually, another topic before that, at one of the boardroom meetings, we had a conversation about.
And I apologize, guys. I'm out of time. I just had an hour. I have a meeting I have to go into. But if you have an urgent question, Jim or anybody else, if you give it to Bailey or Deanna, I will get them an answer for you. And then if not, let's take it up next week when I shouldn't have this constraint.
Appreciate your time. Thanks, Roland.
Okay. Jim, Ramon, send me your questions, and we'll make sure we get you answered. Okay, buddy? All right.
Yep. Just posted it. Thank you.
All right. Thanks, Roland. Have a good day, everyone.
Thanks,
all right.
Morning.
Bye.